Well, it's very early morning in California, and we're grateful to have Anthony Ginsberg, who's going to tell us whether last week's tech stock boom is sustainable. Okay, that's quite an intro for you, Anthony. Where you're in California? What part of California?
Warm Los Angeles, although we're entering winter over here, Alec.
Okay, and what time in the morning is it? Just so that people know if you are a bit sluggish.
It's okay, 7:30 in the morning, but ready to go with you. It's great to reconnect.
7:30 is half the day here in South Africa for our 5 a.m. club. But Anthony, I'm always intrigued to be talking to you because you keep a close eye on what's going on with tech stocks. Earlier today, I spoke with Sean Pesh, another South African. He's based in London. And he was saying, yeah, this is the value ride for a long time to come. But last week, many value investors might have been a little shaken when we saw on Thursday the way that tech stocks reacted so positively to the inflation print. Was that a surprise to you?
Not particularly. Actually, we believe that the Fed has seen the worst of inflation. Most American observers believe the largest inflation prints, Alec, are behind us, and that we'll be on a downward trajectory over the next couple of months. We previously, as you know, hit over 9%. We're down to 7.7 at the moment. It's very likely that the strong dollar, in fact, is helping America reduce its inflation rate. Interestingly enough, the strong dollar will also help big tech earnings because many of them are large multinationals that have been actually hurt by the strong dollar. So we're actually more positive than others that over the next 6 to 12 months, as the inflation prints come down, you'll see improvements across growth stocks, actually, because they've been the ones most slammed by discounting, high interest rates. I'm a boring accountant by training, and yes, it's obvious if you have high interest rates, you're going to hurt the growth stocks. Our view is that things are going to start improving for growth stocks into 2023.
So you weren't surprised to see that as inflation came at 7.7, the market was thinking of 7.9%. That's for the US on Thursday, that we saw Amazon 12%, Apple 8%, Microsoft 8%. I mean, these are huge numbers when you look at their market caps.
Well, the fundamentals of tech remain actually strong. If you look at cloud computing, Alec, it's doubling in size within 3 years. There's $1 trillion of new revenue. It's actually $1.3 trillion of new cloud revenue expected by 2026. You've got something of the order of 50% of all tech revenue expected to go into the cloud. That's just one area. Cybersecurity is sort of a first cousin of cloud. They're bundling cyber services and cloud services increasingly into one. Then you've got the onshoring away from China. Despite Biden's meeting with Xi yesterday, the view here is that onshoring and factory automation, we call it robotics and automation. It's one of our sub-themes. We have a tech megatrend ETF listed on the LSE in London. Again, we're not betting one theme versus another, but we typically use something like 8 different sub-themes, increasingly things like cloud and cyber and robotics, even social media. These things are all benefiting, and they're overlapping in many ways quickly, Alec, because cloud includes 5G. So when you look at the Asian market, South Korea is almost moving to 6G. That speeds up a lot of activity. Work from home clearly fast-tracked the use of cloud. If this coronavirus had happened 10 years ago, we would have all been really stuck in the mud. We were very lucky it happened when it did. The other quick thing I should say about cloud is that online gaming, I've got teenage kids, they used to all use consoles. Today it's moving to the mobile phone. So telephony, cloud, 5G, cybersecurity, a lot of these sub-themes are actually coalescing. So it's very exciting times fundamentally for tech. It's been not reflected at all in their share prices the last 6 to 9 months. We actually think we're trading at almost decade lows, and there are lots of bargains out there at the moment in tech.
Just explain that, almost decade lows. Now, given that you're an ETF man, I'm not going to ask you to give a specific view on 2 of our favorite stocks in the portfolio, Amazon and Cloudflare, but they are in areas, the one, as you said, cloud computing and cybersecurity, which get big thumbs up from you. But really, just before we even go into that detail, a decade lows?
Yeah, if you look at the PE ratios, I mean, we've got a cloud ETF as well as a tech megatrend ETF that covers a lot of these sub-themes. The megatrend had a PE ratio of around 30, 31 earlier, in the year. I'm talking about late December, early January. Now that PE's knocked down to about 19, 20. So we've seen PE ratios compress significantly. In fact, the premium relative to just a straightforward S&P 500 premium. Typically, growth stocks may have a premium as high as 50% more than the S&P 500. That premium has shrunk dramatically. So what you're paying for the S&P, let's say 16 times earnings, now you're paying only about 19 times earnings for many of these tech stocks. So the whole premium relative to the rest of the market has shrunk. So in many cases, there's a bargain basement sale. You just saw Mr. Warren Buffett buy part of Taiwan Semiconductor overnight, spent about $5 billion there. So that's also a boost for the tech sector. We actually think that the industry has been pummeled disproportionately in some ways, whether it was an Apple type stock or an Amazon or even some of the mid caps and smaller large caps that we actually utilize. We actually have an equally weighted approach. There's a big difference towards investing here, whether you go the NASDAQ route and you have a domination, almost a smothering effect of 7 or 8 stocks controlling your entire tech portfolio, or if you do a much more broad-based, we actually have over 100 holdings and essentially are equally weighted across all these various sub-themes, whether it's social media or it's cloud or it's cyber or robotics.
Yeah, you've really got some very innovative and interesting exchange-traded funds in the GINS Global portfolio. But just so that people can understand exactly what we mean, to unpack this a little bit, you guys in America talk PE ratios. In South Africa, you still have to explain them. It's a price to earnings. In other words, it's how many years at the current profit level it'll take to get your money back. And as you said earlier, it was 31 years just a little while ago for tech stocks. Now it's only 19 years. Now that's on this most recent year's profits. Of course, these companies are growing very rapidly, so it'll be nothing like 19 years. But it's interesting, the comparison you say, that these fast-growing shares or fast-growing companies are now very close to the ratings of the old stolid ones that are only going to grow incrementally, not exponentially. So I get what you're saying, but does the market believe you? Does the market believe that this is really the story, or are they more on the value investor side to say, whoa, hang on a minute, value should have its run for a lot longer than just a couple of years?
Yeah, fair enough. I will just say that we see institutional investors in America getting back into the market. They may be dipping their toes in rather than jumping in full hard, but we have seen a lot of a turn in terms of sentiment. It's not going to happen overnight, but if you look at, many of us are old enough, back in 1980, when inflation hit double digits and what happened the subsequent year when the prints started coming down, you had a 25% rebound on the S&P 500. Now, we're not saying that you're going to have the exact same situation, but history does tend to rhyme, and most likely you will see a positive 2023, and growth stocks most likely will push it higher. They've been beaten down indiscriminately, quite frankly. And again, whether you were, a Facebook or an Apple, everybody just got slaughtered. So we actually think that we're not going to see previous levels, Alec. I think we were in all agreement that tech was overvalued. But at this point, many of those well-placed stocks have been beaten down by 30 to 40%, and their earnings have not actually given up the ghost. Their earnings, in many cases, remain strong. Just to give you a quick sense, in terms of big tech, cloud was driving 30 to 40% gains year on year during just the second and third quarters. This is for the likes of Amazon, for Microsoft, which has a division called Azure, and also Google's cloud. So, and big tech, incidentally, are moving into things like online gaming, into social media. There's a lot of crossover going on. So yes, we talk about antitrust issues or anti-monopolistic issues, but big tech is actually able to move all over. One thing I will say about cloud being embraced by the likes of JP Morgan, big healthcare hospital groups, financial services groups, that didn't happen 5 years ago. Cloud actually was seen as a bit risky, that you put all your eggs in one cloud provider's basket. Today, you can use multiple clouds or hybrid clouds, we call it here. So the outsourcing is definitely caught on, and the big regulated industries are now adopting. That's where you get this $1 trillion of additional revenue spend coming through in the next 3 years just for cloud computing on its own.
Well, you'll be interested to remember this, but there was a guy called Paul Maritz who used to be very close, Maritz being South African, just like you, a South African living in America. And he was very close to to Bill Gates at Microsoft. He left Microsoft, started a company called VR, and that was the very, very first cloud computing business. And today, of course, he was way ahead of the game. I don't know if he's still there, but he started it. I remember meeting him in Davos and interviewing him because he was South African. And he said, well, this is the next big thing. And that was 10, 12, 15 years ago. If only we'd all listened, and if only we'd bought Amazon, at that stage, because they were way ahead, weren't they, in cloud?
Yes, they were. But cloud actually benefiting also from the whole digital entertainment, the online streaming of Netflix, Disney Plus. I mean, Disney today's got 250 million subscribers just in barely 2 years for their online streaming. And just quickly, adding a little interest to you as a broadcaster, TV viewership is down year on year here about 10 to 11%. This is through cable and mainstream broadcasting, whereas online streaming is up 21% given the latest numbers. And when we talk about online streaming, gaming is now 4 times larger than Hollywood. Although I'm based here in LA and everyone thinks Hollywood is massive, actually it's a quarter the size of the online gaming world. And online gaming is only going to get bigger. The biggest tech deal this year, incidentally, was Microsoft buying a very large gaming group called Activision Blizzard for over $70 billion. That just tells you something. And the guy said it's not about consoles or about kids playing in front of their TV or computer screen. It's all about social media and mobile telephony.
It's extraordinary how the world has changed. And if you can pick up on those themes early on, what looks like science fiction today becomes science fact into the future. But getting back to the way you reading the market, surely if the share prices of so many of these tech companies have been smashed indiscriminately, and I buy your thesis on that, there must be mergers and acquisitions coming on because, especially in America, the guys are very smart there. They're not sleeping. It's highly competitive. If things are cheap, then you would imagine that there would be more of those kind of deals coming out. Are you seeing that as a trend?
You're 100% correct, Alec. We're seeing more M&A activity. We actually have a chart that M&A did not fall off a cliff this year, and there's a lot in the pipeline. So yes, there are going to be a number of bargains being picked up by the cash-rich leaders in tech. So we're expecting a lot more M&A. The same deal that they could have done at a 50% premium just a year ago, now they're getting it at, let's say, 1/3 off. So expect a lot more M&A. Incidentally, when we talk about tech, the industry went through quite a change. So tech indexes were shrunken some years ago, where they excluded electric vehicles, they excluded online streaming, they've actually excluded even social media. We actually have a broader take on these disruptive themes. They're all interlinked. And one has to be a bit careful when you look at the NASDAQ or you look at S&P Tech or MSCI Tech as a benchmark. They are quite narrow, and often they're smothered, as I say, by 6, 7 large fangs that dominate up to half the index. So one has to be very careful. Again, obviously, we're passive index players. We believe in a much more broad-based approach. Actually, we use an equally weighted approach to avoid these big tech mega caps really dominating our portfolio. So
what does that mean? Equally weighted? What does that mean, and how does that
rebalance every differ? 6 months, so that you don't have somebody like an Amazon or a Microsoft owning, taking up 6-7% of a holding in your fund. So if we have 120 holdings in our tech megatrend ETF in London, what essentially is happening is they each just under 1%, about 0.9% weighting, and it gives us an opportunity to have more mid caps and smaller large caps having a larger role. So we're not dominated by these 6, 7, 8 FANG type stocks. I just wanted to touch on one other quick thing: is electric vehicles here in LA. Just an anecdote. My office building only had one charging station when Trump left office. Today, my 10-story office building has 20 charging stations. So we're seeing EVs, even though Tesla obviously has been hurt and there are people negative on Elon Musk for the moment, that he's distracted with Twitter. The point is that Biden, sort of like the Green Party here in America, the Democrats, they've rolled out tons of spending on electric vehicle infrastructure and various subsidies. So we remain positive, actually, that EVs, they're going to outlaw them here in California. Regular cars will be outlawed on our freeways by 2035. So we see EVs doubling in size essentially every 3 to 4 years in terms of market share.
The one thing we haven't spoken about is politics. Last week was also a very big political week in America with the midterm elections. In other words, halfway through the president's term. It's incredible how quickly it goes, that 4 years. But there was supposed to be a big win for Republicans. They didn't sweep the way that they did. And indeed, many are blaming from the media we read that Donald Trump shouldn't have stuck his nose into affairs, because wherever he did, his supporters got terribly beaten. What's the reading from where you sit?
Well, the reading is that Wall Street and the markets typically like a split government in Congress. Actually, they prefer at least one or two of the houses of Congress being controlled by the other party. So it's actually a real turn-up for the books that Biden has been able to hang on to the Senate, although it's still very close. It's going to be sort of 51-49. He doesn't have a massive mandate there. But the House of Representatives, the lower house, probably will be controlled by a very small margin by the Republicans, which will change the emphasis there. I think Wall Street will rejoice that there's going to be a split in control. Typically, we've seen markets react much more positively when you don't have one party dominating all three levers of power here. Yes, Trump is arguably the biggest loser, Alec, because all the candidates he endorsed for governor, senator, etc., almost all of them failed. So I think in a way, markets like the Florida governor, Ron DeSantis, as the new leader or heir apparent for the Republican Party. He seems a lot more business friendly. Florida, of all the states in the U.S. since COVID, is one of the top performers and is seen as a very business friendly state. Unlike California, where I am, where taxes continue to rise and more red tape and regulations seem to creep in.
That's so interesting. Yeah. It's so interesting that the Florida governor, who also had a fantastic victory over his opponent, the huge victory, landslide, and he's now being benefited also by Donald Trump's putting his foot in it and making a mess of it. But is Trump still a force to be reckoned with? You talk about certainly investors would like to see a business-friendly government in South Africa. We might get that in 2024, but very much in the United States, where you pull the rest of the world with you, a business-friendly, a more business-friendly government there. Is the trend in their direction for the Republicans then?
Yes, I think Ron DeSantis, the governor of Florida, is being embraced by mainstream Republicans and many independents. He most likely should be the Republican nominee. I think many believe here that Trump's days are behind him. So if anything, this election has been a negative for Trump, and his chances of regaining basically the Republican nomination against DeSantis, who had this massive landslide. Remember, Florida is actually a toss-up state. We call it a purple state between the Reds and the Blues here. But he's basically made it a red Republican wave there, even lower on the ballot below him. Many congressional districts went Republican. So, yes, in terms of embracing business-friendly, the Republicans are always seen as the more business-friendly party. Wall Street tends to embrace them a bit more. But I have to give Biden and the Democrats their due. For us in the tech space, things like cybersecurity and electric vehicles, Democrats have been huge spenders in the space. The Pentagon is announcing shortly a $10 billion cloud computing deal, for example. Many of the state governments, local governments are embracing cybersecurity. Electric vehicle rules have been changed, both not just here in California, I mentioned earlier, but also the 2030, 2035 type limitations on traditional vehicles throughout the U.S. have been passed by Biden. And as you know, he's embraced climate change as well. So I think status quo, we have some Republican powers in Congress and you have a Democrat in the White House. That's typically a positive for the U.S. stock market. So we're expecting a good 2023 here and a rebound of sorts.
A rebound for tech stocks?
Yes, absolutely. And I can't, again, tell you that it's only going to be in one patch versus another. There are some big tech like Meta that have actually made some bad decisions. And of course, Tesla, Elon's views are at the moment focused on Twitter. But the broad fundamentals of tech are growing strongly. Robotics, AI are benefiting from the onshoring away from China. Even social media is benefiting from this online gaming explosion, which is expected, by the way, to be 5 times the size of Hollywood shortly. So the fundamentals of cloud and cyber are brought to bear. They're growing at double-digit numbers annually.
Anthony Ginsberg from Gins Global. You can recognize that accent. Well, most of it. You're throwing in a few Americanisms there. Anthony, always good to talk with you. I'm Alec Hogg from biznews.com.